Schedule C. Now this is a very popular form. If you're a sole proprietor, single member LLC, you file your business income and deductions on Schedule C. It doesn't matter if you're doing $5,000 in sales, $100,000 in sales, or $50 million in sales. If the business is owned by one person, this is where the income is reported, on Schedule C within the personal income tax return, Form 1040. Remember that all business income is taxed personally unless the business is taxed as a C corporation. But if you're a partnership or S corporation, you have to file a separate tax return for the business, showing the breakdown of your income and expenses, how much you paid in rent, advertising, payroll, office supplies. But if you own the business by yourself, the Schedule C within your individual income tax return is where you'll show the IRS your breakdown of income and expenses for the business, because you don't have that extra partnership or S corporation tax filing. Now you can have multiple Schedule C's within your tax return, and you should have a separate one for each entity that you own. So if you have a t-shirt business but also sell real estate, make sure to break out those income and expenses on 2 different Schedule C's, because your numbers will be analyzed differently by the IRS based on your industry and other metrics. So let's dig into the form. First up is the name of the owner of the business. Remember, a single member LLC is a disregarded entity in the eyes of the IRS. So right off the bat, they want to know who owns the business and what their social security number is, in case they ever have any questions. Since this is within your individual income tax return, the only options here can be the taxpayer or the spouse. But again, a separate Schedule C should be included for each entity. Next up is the principal business. And this is really important because this is where the IRS learns a little bit more about what type of business you're reporting income from, so that they can analyze your income and expenses. If you're a real estate agent or a hot dog cart vendor, just think about it. Your income and expenses will look very different. So this is a way to keep track of those metrics, to identify outliers and potential areas to analyze further. Next to the type of business is the NAICS code, which is the North American Industry Classification System code. And this groups together similar businesses to help identify common expenses for the type of business. If you have a single member LLC name and EIN, or a DBA or fictitious name with an EIN, you'd input that on lines C and D, but it's not required since the IRS already knows who owns the entity. Then you have to report your accounting method, whether or not you materially participated in the business during the year you're reporting, and whether or not you fulfilled your duty to issue 1099s to the subcontractors that were required to receive them. Now this is the easiest of questions for the IRS to double check, because if you issued 1099s, they'd be on file with the IRS already. So make sure you get your 1099s out to your subcontractors and answer this question honestly. Part 1 is all about your income. Any gross receipts or sales you collected, less any direct costs that you had in selling those products. Remember, cost of goods sold. And that gets you to your gross profit on line 5. And this represents the money left over after your direct selling costs and before any overhead expenses. Are you noticing why the accuracy of your books and records is so important? The profit and loss is organized exactly how Schedule C is. Next up is Part 2, your overhead expenses. And this is where you'll tell the IRS about the total amount you spend in advertising, insurance, interest, office expenses, rent, supplies, and so much more. And of course, the famous catch-all, other expenses. Other expenses are reported line by line on page 2 of the Schedule C, Part 5. You have to list out all of your other expenses along with the corresponding amounts. So make sure that nothing you're putting on these lines is questionable. For example, don't put an expense of paying myself $5,000 because that's not a business expense. And neither is a parking ticket or a credit card payment. These are easy reasons for the IRS to pick your tax return for questioning, which would just lead to more headaches. Once you have all of your expenses totaled up, you now know your tentative tax profit or income. However, there's just one more adjustment to make, and that's the business use of home adjustment. The IRS recognizes that some sole proprietors use their homes for some aspect of business, meeting with clients, manufacturing, etc. If your business uses a section of your home exclusively for business, then you're able to deduct that portion of your home as a business use of home expense on your Schedule C line 30. You'll total up all applicable expenses: mortgage interest or rent, utilities, real estate taxes, renter's insurance, homeowner's insurance, etc. And you'll use the square footage of your home to determine the business use. And then you'll multiply that percentage by your total allowable home expenses to find your deduction amount. This is an area that can be easily exploited, and also easily provable by the IRS as to whether or not the area you've identified is actually exclusively used for business. So be very careful not to be too aggressive here. And once you have your business use of home deduction, if any, then you know what your net income from Schedule C is. And that is what you'll be taxed on. So your net income or net profit is the amount of self-employment income subject to both self-employment taxes and ordinary income taxes. So you want to make sure you're not missing any applicable deductions that will help reduce this amount as much as possible, so that you don't pay any taxes that you don't owe. But keep in mind that while the goal for most people is to reduce their income as much as possible so that they pay in as little taxes as they're legally allowed, if this is your only form of income and you're looking for a loan or a mortgage, banks will want to see income generated from a business to know that you can cover any loan or mortgage payments you'll need to make. Banks don't care if you got too aggressive with your business use of home and fudged the numbers to add in some advertising costs so that you only showed $1,000 of profit on your tax return. They go by what's reported to the IRS. So the less profit they see, the less they'll want to lend to you. It's a very delicate line to walk. If you found this video helpful, we're real accountants and CPAs who work with hundreds of small business owners just like you every day. Check us out at engagecpas.com to see if we're a good fit for your business. We also have business courses available to help small business owners understand their business. They're for you to learn about your financials, your taxes, how to pick the right entity, tax myths, and everything else about your business. Learn at your own pace. Check those courses out on the Education tab on our website. You can also find us on Instagram at Engage CPAs.